The only way to win the game is to stop playing. You have to play your own game. Don't try to play the game that professional investors play. And Graham instead is saying, tune out Mr. Market. Stop listening to people who tell you that because some sort of action is going on today, you have to participate. Instead, you should wait for opportunity to come along.
Hi, folks. I'm really delighted to be joined today by my old friend, Jason Zweig. Jason writes the Intelligent Investor column in the Wall Street Journal, and he's now created a revised edition of Benjamin Graham's iconic book, The Intelligent Investor, 75 years after the first edition was published. Jason, it's really lovely to see you. Thanks so much for joining us.
I am delighted to be back with you, William.
It's a great pleasure. I was looking the other day. You were episode number 4 was the last time you were on, back when we were younger, and I have much more hair. So, Jason, back in, I think it was May 2023, you sent me an email telling me that you were going to take a book leave from the Wall Street Journal to work on this new 75th anniversary edition of The Intelligent Investor. And you described it to me in that email as a huge honor, a huge task, high stakes, and a brutal deadline. And you then basically disappeared for about a year into your man cave. And so I wondered if you could talk a little bit about the experience of writing the book, why it was so intense and stressful, and why you regarded this project, both, as you put it, as an incredible honor and burden.
I think from start to finish, it was 7 months, although it often did feel like 12. And, well, it's easy to explain the honor, by pretty much everyone's account. It's, the best book on investing ever written, starting with Warren Buffett, but many other people have said it. And, my role is not to rewrite Benjamin Graham, which would be kind of like rewriting Holy Scripture, but to rewrite the commentary that helps today's investors understand what Graham was saying, because of course he originally wrote the book in 1949. He last revised it in 1972. So it's a 75-year-old book, and the principles all remain valid, in my opinion. In fact, may have become more valid over time. It's quite a responsibility. And the main technique I used to revise what I had written in 2003, the chapter commentaries, was I never looked at them. What I did was, I'm still somewhat paper-based, like everybody. I love, electronic files. But for certain tasks, I really like to work with paper. If I'm reading a great novel, as I think you know, William, I really like to read a physical book. And for a project like this, it was very important to me to have paper when I started. So what I did was I took my master copy of the PDF of the last edition, and I printed out every one of Graham's chapters, but none of my commentaries. And I never looked at what I had written 20-some years ago. And in fact, I still haven't. I never looked back. And I just said, starting from a blank slate with no sunk costs, how should I approach this project now as if I had never been involved in it before? And that just enabled me to get like arm's length distance from the original material, and especially from my own, so that I could approach it freshly. Readers will judge whether, it's successful, but it was the only way I knew to approach it that wouldn't drive me crazy. Because otherwise, I just would have been trying to improve what I had done. And instead, I said, I'm going to pretend I never did anything at all and start over.
I think it's remarkably successful. I finished reading the book this morning. It's a huge book. You sent me a PDF a few weeks ago, and for the last few days I've been working through, 600 pages. And but it's a remarkable achievement. I mean, it is a totally classic book. It's totally timeless in certain ways. And in some ways, it's a little tired in certain parts and a little dated in certain parts. And you've done such a masterful job of kind of putting those bits in context, providing new examples that revitalize it. And without blowing smoke, as I was reading it yesterday, I was thinking there's actually nobody else who could have done it. Like there's something about the fact that you've been engaged with this material for so long and you're drawing on so much personal experience of the markets, but also so much that you've written. And so the data was kind of in the filing cabinet in your head for you to draw on in 7 months. And I know, having written some books very quickly, albeit not my own, but the ones I've ghostwritten, it requires so much, that intensity to go into your head and draw this stuff out quickly. And it's kind of game day again and again and again for month after month. So it's an extraordinary achievement. And so, yeah, really kudos to you. It's an amazing thing that you've pulled off.
Oh, well, thank you, William. I mean, what would I say? I guess the only thing I would say in response is I don't know if it's any good. I only know that I can't make it any better than it is anymore. So, I tried as hard as I could to make it the best book I'm capable of. And, I hope I succeeded.
When you decide to take something on, do you have a particular filter that you apply to decide, okay, this is worth the pain and suffering I know I'm going to go through? Because you already have a day job that's very demanding at the Wall Street Journal. And, you get asked to do lots of speeches and stuff. And you're married and you have a couple of kids and, dealing with elderly relatives and stuff over the years. You have a lot of family responsibilities and work responsibilities. How do you decide, okay, even though I'm already overburdened, I'm going to burden myself more?
Well, so in this case, I don't feel I had a choice. I couldn't very well turn the project down. And it also was obvious that 2024 was the best year to publish it. I mean, it's the 75th anniversary of the original book. It's also the 130th anniversary of Ben Graham's birth. And the publisher is not overemphasizing the commemorative nature of it, but I think it'll be obvious to a lot of readers that there's historical significance to the date. The rule I've always used for book projects, and it certainly applied in this case, is, the only book anyone should ever write is the book that's already inside of you, sort of banging on your rib cage from the inside, saying, let me out. I once did a book, which I will not name, that I did not do because it was inside of me screaming to be let out, but rather because I thought the money would come in handy. And I've regretted it ever since. Don't press me on it because I'm not going to name the title of some book. But that's not something that's, given my personality, that's not the kind of project I would want to be involved in. This is, the connection to Graham is personally important to me. It's been very important to my career for, well over 20 years. So I really felt I had to do it. And I would have felt foolish not undertaking.
And when you're working on something really intense like this, or like your column, what do your habits look like? And, how are you actually managing to get so much done and to focus? And what's deeply idiosyncratic there and what's possibly replicable for people who regard you as a superhero and role model?
Well, first of all, they should find some other heroes, but I don't think I have a lot of magic tricks on, people ask me, oh, you must drink a lot of coffee. I don't even drink coffee. I'm a tea man myself and not much. If I have a gimmick that I really like to go for long morning walks. When I was working on the book, I went for a walk almost every morning early, sort of before breakfast, 2 or 3 miles. Wasn't that long. But toward the end of the book, I was walking 5 to 7 miles a day. And I often do that during the regular work week as well. In fact, I walked so much at some point that I broke a bone in my foot. I'm a big believer in walking to clear your head. And what I find is that when I'm on a long walk, a satisfying walk, my mind empties out completely. I'm not thinking about the project. I'm not thinking about work. but there's probably some subconscious level at which my brain is doing some problem solving while I'm looking at the trees or the river or whatever it might be. It's like software that's running in the background, maybe in the next room, while the computer seems to be idle. And I think that helps. Obviously, I'm not the only writer who loves to walk, and I guess we would call that think. I mean, I'm not, in my conscious awareness, I'm not thinking about the project, but surely I am on some level.
I did a lot of walking while I was working on Richer, Wiser, Happier, the book. And I think at some point during that process, I had listened to a podcast that Josh Waitzkin, the author of The Art of Learning, had done. And one of the things that he was talking about, basically setting a goal for your subconscious mind. So you would actually ask what he would call the most important question. So I would do this at the start of walks often. I would say, all right, while I'm walking, I'd like my subconscious to work on this issue in chapter 2. Because what the hell am I supposed to do to synthesize everything that Templeton figured out in the course of 93 years or whatever it was? So I think it's interesting that, I don't know whether that's bogus or whether it really works. But I think it's very interesting, the connection between walking and figuring out these difficult problems.
Right. And there might be no difference between whether it's bogus and whether it really works. Maybe, again, at a subconscious level, we think it works. So if we think it works, it does work. It may be some weird manifestation of the placebo effect, But that's kind of my only gimmick. The other gimmick I had was that for most of the period from April or May through August, I wrote on my laptop, on my Mac, which was at a standing desk, and the desk I used was truly low. So I propped the laptop up on my copy of the 2-volume Oxford English Dictionary, which you probably own. I don't know how many of our listeners do, but it's probably, 8 or 9 inches thick, right? And I imagine that one reason I chose that was because I was just thinking to myself, words. There's lots of words in there, and I want to pull them out. I never looked at my podium, my platform. I never looked at it. I never said to myself, oh, that's the Oxford English Dictionary holding up my computer. But it was, and that probably did hurt. I mean, I think a successful writing project, like any big task that can feel insuperable at first, is about coming up with little gimmicks and hacks that, enable you to kind of fool yourself about stuff. And some of them will be conscious and some of them will be subconscious. But other than those two things of walking and using a dictionary as a podium, I don't know what else to mention.
Did you feel any kind of conscious connection to Graham himself as you were working? Like I sometimes felt like when I was writing about Templeton, for example, I felt like I was sort of almost in an argument with him, that I was sort of thinking about this dead guy who I disagreed with at the time I first interviewed him, and then was thinking, what did I totally fail to understand that he was trying to teach me back then? Mm-hmm. And I realized during that process, oh God, I totally misunderstood what he was trying to teach, and he got kind of frustrated with me. Yeah. And I was wondering if you had some kind of sense that, without wanting to be too mystical about it, which really means I want to be too mystical about it, did you feel in some way that you were communing with Graham or trying to sort of honor his memory, at least in some way?
I would say above all else, the thing that really stands out for me about Graham is how brilliant he was in how many forms of brilliance. I would never use a term like Renaissance man because it's been so degraded in, popular culture. So Graham entered Columbia University at the age of 17 because the admissions office had bungled the paperwork. They admitted him when he was 16, but they lost the acceptance paperwork. So he had to wait a year. So he entered when he was 17 years old. He graduated in 2.5 years while working a night job in a shipping company in downtown Manhattan. He graduated second in his class. And before graduation day, he was offered faculty positions in 3 different academic departments: philosophy, English, and mathematics. And when he was 23, he published an article in the American Mathematical Journal about what was wrong with the way American schools were teaching calculus. He invented 2 sort of predecessors of the slide rule, which he patented. He wrote a Broadway play. He could speak or read at least a half dozen languages, and late in his life, well after the age when most people are prepared to try to learn a language, he heard about a novel written in Uruguay that was supposed to be great. So he taught himself Spanish and translated it. And you combine all of that with the fact that he also racked up one of the most extraordinary track records in investing history, which in an email correspondence that I had with Warren Buffett last year, Buffett pointed out Graham's sort of published track record understates just how good his investors' results were, because he closed his fund down in 1956. And the fund then distributed out to its shareholders its huge position in Geico. As part of the dissolution of the fund, these people all received shares of Geico. And if you had held onto those, as Buffett pointed out, you not only would have beaten the market by something like 5 percentage points a year for 20 years, as you would have in Graham's fund alone, but you would have outperformed even longer by an even wider margin because of the position in Geico.
And then, as you point out in the book, well, I guess you reprint the Super Investors of Graham and Doddsville, the great article that Buffett wrote. And Buffett describes him as the intellectual patriarch of many great investors. And so Buffett himself worked at Graham Newman from 1954 to 56. Walter Schloss was there, Tom Knapp, who was a co-founder of Tweedy Brown, Bill Ruane, who was an amazing investor who took Graham's course in 1951 with Buffett, Munger, Rick Guerin. They were all kind of disciples in different ways. And as Buffett points out, really the central idea, I guess, that they all learned is to exploit the difference between the market price of a business and its intrinsic value. You spend a lot of time talking about the core principles that are kind of timeless, and you talk about 4 of them. Can we whip through them quickly, and then we'll dig deeper into really what the 2 most important chapters probably are, which is chapters 8 and 10.
8 and 20, yeah.
Sorry, 8 and 20. You can see that I'm tired. It's because I've been reading this 600-page book until 12 hours.
Yes, I don't blame you. Yeah, so let me see if I can run through them and, stop me or add on if I'm forgetting anything. So the first important principle is, stocks are not pieces of paper. They're not electronic blips. They're not a thing that buzzes and goes diagonally upward or downward on your phone. Stocks represent an ownership interest in a business. And it's much easier for people to forget that today than it was in Graham's day. But it's much more important to remember it, because if you are going to differentiate yourself from other investors out there, the most important thing to do is to be different and to stop thinking like everybody else. And if everyone else is going to trade stock with the same kind of mentality they might bring to betting on a football game, or now a presidential election, then what you should be doing is you should be analyzing stocks like businesses and judging them not based on their momentary price movements today or this week or this month, but how the value of the business is likely to change over the course of years to come. So that's the first principle. The second really important principle is the difference between investing and speculating. an investor puts original, careful, thorough, thoughtful research into establishing the value of a business based on the cash that it's going to generate in the future. And a speculator is essentially betting on what other people are going to do, typically in the short term. And it's immaterial to a speculator how healthy a business is. All that matters is how much is the stock going to move up or down. And as Graham wrote many times, there's nothing inherently wrong with speculating. Millions of people insure their houses and their cars and are very conservative, but like to go to Las Vegas for the weekend or bet on a basketball game. And if you enjoy that and you don't put any more money at risk than you can afford to lose, there's nothing wrong with it. But the key is you need to recognize that you're speculating and not tell yourself that you're investing. And you need to speculate with no more money than you can afford to lose. Thirdly, you can't add to your speculative wallet no matter what happens. You set a fixed finite amount of money aside. You make your bets. If they win, that's great. Keep going. And if they lose, you have to stop and you can't put more money in. And that's a really powerful principle from Graham. The third really important idea is the metaphor of Mr. Market. I think a lot of our readers, listeners are aware of this concept. I mean, Graham came up with this wonderful metaphor that you own a piece of a private business. It might be a dry cleaner or, a video game producer, whatever it might be. And you have a next door neighbor. And every day he leans across the fence between your place and his, and he offers to buy you out. He's like, you own that business, I'll buy half. And some days he offers you a ridiculously high price. And some days he offers you a laughably low price. And you wouldn't take that man seriously. You wouldn't say, oh, I'm the owner of a wonderful business. Let me sell it to this guy who thinks it's garbage and is offering me a stupidly low price. You would refuse to transact with him. On the other hand, if he offered you way more than it was worth, maybe you'd sell it to him and you'd start a new business all over again. And if people thought about the stock market as a manifestation of that metaphor, they'd all be better off. I mean, the example I've been thinking about a lot is what happened on August 5th. I think certainly all our professional viewers and listeners remember. I mean, the Japanese stock market crashed and went down, whatever it was, over 12% in a single day. And the next day it went back up 10%. There is no explanation in financial theory to explain how that is possible. The assets of Japanese corporations were not worth 12% less on one day and 10% more the next day. It just does not happen. And it made no sense whatsoever. There was a panic in the U.S. U.S. stocks went way down too. They went down all around the world. And then the next day they bounced right back up again. You could argue that was investors trying to reprice risk. But Graham would say, no, it was just Mr. Market. He was crazy enthusiastic the first day. And the next day he was crazy pessimistic the first day and crazy optimistic the next. And when all was said and done, it was as if absolutely nothing had happened. And that's just the way it is.
Yeah, there's a lovely line in that section about the parable of Mr. Market, where he says he referring to the investor, because all investors are male, obviously, in that era. He should always remember that market quotations are there for his convenience, either to be taken advantage of or to be ignored. And so it's like this whole idea that the market is there to serve you.
That's right. And Graham has this other wonderful line where he says, you should transact only to the extent that it suits your book and no more. And of course, by your book, what he means, it's your portfolio. So you would buy when Mr. Market is depressed, and if you need capital, you would sell when he's euphoric. But otherwise, you would ignore him because he's crazy.
You mentioned actually in your explanation of chapter 8, exactly the line you were just talking about. You say that when you wrote in the 2003 edition that these words may well be the single most important paragraph in Graham's entire book, you said I was wrong. Actually, those words may well be the single most important paragraph about investing ever written. And so I wanted to draw more attention to this paragraph that you're talking about, which includes the line you just mentioned. And so I'm going to read it quickly, and then if you can explain to us why this is so significant.
Yeah.
And I think this also gets at your fourth principle, which is the one that we haven't mentioned, which is that basically most of the time markets are right, but they can be terribly wrong at times.
Yeah.
So the paragraph that Jason says is the most important paragraph ever written about investing is this: the true investor scarcely ever is forced to sell his shares, and at all other times he is free to disregard the current price quotation. He need pay attention to it and act upon it only to the extent that it suits his book and no more. Thus, the investor who permits himself to be stampeded or unduly worried by unjustified market declines in his holdings is perversely transforming his basic advantage into a basic disadvantage. That man would be better off if his stocks had no market quotation at all, but he would then be spared the mental anguish caused him by other persons' mistakes of judgment. So explain to us why that's so important. Can you just break that down for us?
Yeah. Well, I think the reason it's so relevant for today's investors is very simple. It's because, particularly if you're an individual investor, but also very much so if you're an institutional investor, you're bombarded all day long by propaganda from the financial industry telling you, act now, trade zero date options, use leverage to buy this, and, grab this ETF before it goes up more, or this stock is cheap, or this market expert thinks, stocks are about to crash, or go straight up. And it all has the effect of making investors feel that the way to win is to play the same game as institutional investors. As an individual, I should try to beat the S&P 500 with individual stock picks and trade as often as necessary and ignore taxes and trading costs and stay constantly updated on my phone. And what Graham is really saying is the only way to win the game is to stop playing. You have to play your own game. Don't try to play the game that professional investors play. Over time, something between 2/3 and 80% of all professional fund managers underperform, certainly the S&P 500 and often other benchmarks as well. And that's mainly because of the frictional cost of trying to beat the market. If that's the game you're playing, you have to trade to play it. And Graham instead is saying, tune out Mr. Market. Stop listening to people who tell you that because some sort of action is going on today, you have to participate. Instead, you should wait for opportunity to come along. And that's a function of basically being contrarian. During the COVID crash in 2020, instead of hunkering down in cash, step up and buy. During the decline in the market in 2022, step up and buy. Do the opposite of what the prevailing propaganda tells you instead of trying to go along with it. When he says to spare you the mistakes of other people's judgment, what he's really talking about is thinking for yourself and becoming independent. And the really unfortunate thing is that for at least 20 years, ever since the internet came along, the dominant propaganda in the financial industry, both in advertising and in product developments like apps on your phone or brokerage websites, has been that if you have the same tools as the professionals, you can compete with them. You can outperform the professionals. But why would I want to try to outperform people who are underperforming? I would much rather compete against Mr. Market rather than try to do what he's doing. And that's really the lesson that Graham is driving at here, which is that you should take the emotions of other people as contrary indicators, and you should be taking the other side of regression to the mean. When other people are enthusiastic, you need to be skeptical. When other people are despondent, you need to be optimistic. And, years ago, I once asked Warren Buffett about this, and Bill Miller as well, and they both said the same thing. I said, people often describe you as unemotional when you invest, but is that really it? Or is it that you're inversely emotional? You get a kind of excitement from picking up on other people's negative feeling, and you get a sense of danger or caution from other people's enthusiasm. And Buffett and Miller as well said, inversely emotional is a much better way to describe it than unemotional or even rational. It's just taking the opposite of other people's dominant emotional state.
I was surprised that at one point in your commentaries on one of the chapters, you talked in some depth about the advantage that individual investors can have over professionals. And we usually regard individual investors kind of as the mug. It was very interesting to me that you said actually the handicaps on institutions have become as heavy as chains, while those formerly faced by individuals have fallen away. Can you talk a little bit about why actually the individual now, almost for the first time, at least an individual who's disciplined and has good processes and procedures for investing, can actually do really pretty well?
Yeah. So, historically, if you go back decades, most of the trading volume certainly in the U.S. stock market, and I'm sure in other markets around the world, was done by individuals. Institutions bought and held, often for tax reasons and sometimes for other reasons as well. And individuals traded because their stockbrokers were making them trade. And naturally, it was extremely expensive to trade individual stocks because it was a retail rather than a wholesale price. Because the wholesale purchasers of stock were not doing much trading, and the retail purchasers were. So it was a retail market, and it was priced like a retail market. I still remember the first trade I ever made when I was in high school. And I think cost for a round trip trade was, I don't know, it was 5 or 6%, isn't it? And I actually did make money even after my brokerage costs, but I would have made a lot more if the broker hadn't, robbed me. And that was just the way. I think he was just charging what then was regarded as a standard commission. I don't think he was even doing anything unfair or improper. It used to cost a ton to trade an individual stock. And of course, now you can trade a stock for close to free. It's not completely free because there still is a spread between the bid and ask price that your broker will skim off, even if your broker is Robinhood, which insists that trading is free. And that cost isn't negligible, but it's well under 1% in most cases. Institutions have to trade huge blocks of stock. I mean, they often own tens of millions of shares of a single security. And to get into that position and out of that position is incredibly expensive, not just in terms of commission or spread, but also the total implementation cost, which includes the delay. If I'm a professional portfolio manager and I don't own, you name it, NVIDIA, and I decide I really want to own NVIDIA, it could take me weeks to build up a position at a price that isn't incredibly disadvantageous to me. Because I don't want to make my brokers rich. And I don't want to eat a big spread. And I might have to buy a few hundred shares a day until I amass my entire position. And if the stock runs up over that period, I've incurred an enormous opportunity cost. And that comes out of my hypothetical return and helps explain why my fund has not performed as well as it should have. Because it took me too long to build up the position because I manage so much money. But if I'm an individual investor and I decide I like NVIDIA, I just grab my phone and buy it. And I can use a limit order so I don't get gypped on an adverse price move. And it'll essentially cost me nothing. And I can hold it through good times and bad. I don't have to worry that my clients will fire me because I don't have any. I might have to worry about what my friends and family think if I, tell them everything I'm doing. But I'm in a better position than most institutions. I have no expense ratio. Doesn't cost me anything to own the stock. And furthermore, I could put most of my money in a total stock market fund, like an ETF that owns all the stocks in the US or all the stocks in the world, so that I have no fear of missing out on the general upside in the markets. And then with a small portion of my money, I can make concentrated bets and pay close attention to those companies and see as opportunities develop and capitalize. And those are all really powerful advantages that are a total luxury for most professional fund managers nowadays. They would kill to have those advantages.
I think one of the things that came through very strongly for me on this reading of the book, which I guess I've read a few times over the years, is the distinction that Graham makes between defensive and enterprising investors. So not only this question of whether you're an intelligent investor or a reckless speculator, but also this question of whether you're equipped to be enterprising and aggressive. Can you talk about that? Because I think, while it's true that we have advantages as individuals, obviously one of the points you've made many times over the course of your writing career is that you have to have some self-awareness about whether you're actually equipped to win this game.
Yeah, exactly. So, yeah, I love this distinction that Graham drew, and it's very sophisticated, even though it sounds very simple. And as usual, he was decades ahead of his time. I mean, when you and I first started, covering the investment business, it was extremely common for fund companies, stockbrokers, financial advisors to bucket individual investors into three piles, right? You were conservative, moderate, or aggressive. And human beings love things in threes, right? Like ABC, 1, 2, 3, Father, Son, Holy Ghost, you name it. Everything comes in threes. And the financial industry loved it because it was simple, it was catchy, it saved people a lot of work. And they would just take every client and they would just say, you sound conservative. Okay, you go 80% in bonds, 20% in stocks. And you sound moderate. We're going to give you 60% stocks and 40% bonds. And you sound aggressive. So we're going to give you all stocks or 90% stocks, or maybe if I'm aggressive, I'll recommend to you that you even leverage and, buy more than 100% in stocks. And I mean, you don't have to think about this for more than a few seconds to realize that it's ridiculous, because there's more than three kinds of people. I mean, and furthermore, people are complicated. They're conservative in one aspect of their life, and they're aggressive in another. They bungee jump, they ski off the trail, they drive race cars on the weekend, and then they keep all their money in a money market fund. I mean, you can't pigeonhole people that simply. And so Graham had a much more useful practical distinction. And he described only two kinds of investors. And in this case, I think that's a really useful way to divide the investing population because it actually applies. And he said, you're either defensive or you're enterprising. And if you're defensive, it doesn't mean that you don't like risk. It doesn't mean you don't want to take risk. It doesn't mean you have all your money in cash or should keep it there. What it means is you don't want to be bothered doing the work, putting in the time and effort to be an active investor. And what you're defending yourself against is the stress, the time commitment, the monitoring, the expense of being an active investor. And of course, active doesn't have to mean you trade a lot, but it does mean you trade. And then the other category of investor is enterprising. And an enterprising investor is somebody who is willing to put in the time, the effort, the energy, the commitment. And, I would say most people are defensive. And if you are, then you don't have to put in the work. You don't have to spend the time and commit the energy that Wall Street and, the financial industry would like you to do. And the ultimate reality is that if you think you're enterprising when you're actually defensive, sooner or later you will discover that you're not defensive, because you will be there in 2021, trading GameStop and AMC and Bed Bath and Beyond, and thinking, whoopee, every day I'm making, under 50% on my money. And the next thing you know, these stocks go down 80 or 90%. 2022 was a bloodbath for everybody. And all of a sudden you're saying, wow, I thought I knew what I was doing, but I really was just in the right place at the right time. And I don't like this feeling at all. Because now I know I'm out of my depth. I don't understand why I lost money. I don't understand how to reverse my losses. And that's the difficulty. And that's why it's so important to the financial industry to try to talk people into being enterprising, even if they really aren't. Because those are the people that brokerage firms make the most money off of.
Your description of all of those investors who got eviscerated in recent years by kind of thinking they were more aggressive and more knowledgeable than they were brings us to another really, really central principle that I think as I was working on my book, it struck me as sort of almost revelatory that it wasn't just Buffett and Munger and Graham. It was Howard Marks, Joel Greenblatt, everyone I was writing about practically. This was the single most important principle, which is the margin of safety. And so chapter 20 is titled Margin of Safety as the Central Concept of Investment. And it begins with this just critically important sentence where he writes, in the old legend, the wise men finally boiled down the history of mortal affairs into the single phrase, this too will pass. Confronted with a like challenge to distill the secret of sound investment into 3 words, we venture the motto, margin of safety. It's so beautiful on so many fronts. I mean, it's brilliantly written. It's steeped in his knowledge of classical literature. And it captures something so essential. Can you talk a bit about the concept of margin of safety and why it's something that's become so central for all of these great investors?
I'll start that way, William, and then I'll take it in a slightly different direction, I think. So, at heart, all the margin of safety means is that when you buy an asset, you want to make sure you don't pay more for it than it's worth. And if you think back to 2020 or 2021, when millions of people thought they were investing when they were speculating because they had not done their homework, they had not valued these stocks as businesses. All they knew was that other people were buying them and they were going up. So none of those people gave a moment's thought to a margin of safety. If you bought Tilray at, marijuana company, or, Nikola, the electric truck company, just because a whole bunch of other people were buying it, you lost pretty much everything you put in unless you got out at just the right moment. And if you had tried to calculate a margin of safety for companies like that, I think you would have either concluded that there is none or it's impossible to say what it is. And in the most basic terms that are applicable for individual investors, if you haven't read, say, 3 years of a company's annual reports, it's 10K, and you haven't read the past 4 quarterly reports, you don't know anything about the company. You only know about the stock. And if the only thing you know is that the stock has been going up, you have no clue what the margin of safety is or whether there is one. And professional investors, of course, will calculate a margin of safety in very formal ways. They might use a discounted cash flow model, various versions of dividend discount models. And it's not a trivial or universally agreed solution. I mean, when you calculate a margin of safety, you're probably going to come up with a range of values, not a point, not a specific point. But what individual investors need to realize is that if you haven't studied a company and all you know about is the stock, then literally clueless about what the margin of safety is because you don't even know if there is one. But there is one very important development that has occurred since Graham's day, and that is that diversification has effectively become a free good. And in the marketplace, you can buy, as I mentioned earlier, you can buy a total stock market fund. You could buy a total international stock market fund. You prefer bonds, you can do the same thing in the bond market. You can do that for real estate. You can do that for most major asset classes. And that can provide a different kind of margin of safety. It doesn't provide a margin of safety for a specific idiosyncratic asset that you may be buying. But what it does do is it provides you insurance in the background against the risk that you could lose all your money if this thing goes to zero. Because if you own the entire market, you then can afford to make a specific bet on a piece of the market. And that is not something that Graham really contemplated, although he hinted at it in some of the things he wrote late in his life, when it looked as if index funds might be a development on the horizon. And as you know, I've been an advocate of index funds for, decades. And it's not purely because I think, in fact, I would say it's not because I think attempting to beat the market is futile. It's because it's the most efficient way to invest. You have exposure to the performance of the entire asset class. And it's fine if you stop there. But if you want to try to outperform, then it's really good to have that index fund as the base of your portfolio. And then you can overlay a few specific bets in companies or other assets that you feel you really know something about.
I was looking last night after reading the book. As I wrote about it in my book, I'm always torn between indexing and the desire to try to outperform. And I was interested to see, I think I have a third of our family's investments indexed. And I'm always sort of torn emotionally, but I feel like at least I don't want my wife and kids to suffer for my own delusions. So I tend always to index their investments.
Mhm.
But it's yeah, I like the idea that index funds should at least be a sort of, the foundation on which the portfolio is built.
Mhm.
Feels
Yeah.
like the default.
Yes. And, this is especially true, of course, for individual investors. I mean, if you're running a professionally managed portfolio, you're going to have a hard time convincing people to pay you for putting 95% of their assets in an index fund. Although there are a lot of financial advisors out there who do that, now that I think about it. But I think you'd have a hard time running a fund doing that. But your results might well be better, because then you would only invest in the things where you felt you had a real advantage, and the rest of the portfolio would track the market. So if you turned out to be wrong, you wouldn't underperform by much. And if you turned out to be right, there's the potential to outperform by a lot. And we know that the distribution of stock returns is very heavily skewed. Most stocks don't make money over time, but those that do make a ton. And there's a very limited number of stocks that can go up 10,000% or more over the long run. And if you happen to catch one of those and you don't dilute it with, 150 other investments, but you simply add it on top of an index fund, you could have really significant outperformance.
There's a very interesting and important study that you mention in your commentary on one of the chapters, which is this seminal study by Hendrik Bessembinder on shareholder wealth enhancement. He basically looks, as you explain in your commentary, at 28,000 or so US stocks from 1926 to 2022. So a very long period and a very large number of stocks.
Yeah.
And he basically concludes that nearly 59% of all of those 28,000 or so stocks actually lost money for investors over their full histories. And then you point out the study also shows that only 966 of those stocks, which is basically 3%, a little more than 3% of the total, accounted for the cumulative net gain of the entire US stock market.
Buy low, sell high. It's easy to say, hard to do. For example, high interest rates are crushing the real estate market right now. Demand is dropping and prices are falling for many of the best assets. It's no wonder the Fundrise flagship fund plans to go on a buying spree, expanding its billion-dollar real estate portfolio over the next few months. You can add the Fundrise flagship fund to your portfolio in just minutes with as little as $10 by visiting fundrise.com/WSB. That's fundrise.com/WSB. Carefully consider the investment objectives, risks, charges, and expenses of the Fundrise flagship fund before investing. This and other information can be found in the fund's prospectus at fundrise.com/flagship. This is a paid advertisement.
So there's something really interesting here about the outsized importance of great businesses, of the real winners. And various people I've talked to on the podcast and privately have commented a lot on this. Like some like Peter O'Keefe, who's a remarkable investor who I interviewed on the podcast, said his job is to find that small number of stocks that outperform, and they're identifiable to some extent. And that's his entire business, basically. Then there are other people who say, well, no, I should index because the chances are then that I'll at least have some of those companies in my portfolio and will benefit from them. And I'm wondering how you think about this kind of central conundrum that a lot of us are facing as investors.
Yeah, so this gets back to why Graham's idea of defensive versus enterprising investors is so powerful. If you're a defensive investor, you don't have to have an opinion on this. You can simply say, maybe some people are capable of identifying that tiny minority of stocks that will outperform, but I'm not capable of identifying those people. So therefore, I will just own the entire market, and I will benefit from the fact that in that market index is represented the big winners of the future. If you're an enterprising investor, it makes a lot of sense to try to identify those companies. But I think you have to recognize that the odds are against you. Most people couldn't do it, because if most people could do it, the stocks wouldn't outperform. So most people who can do it might be highly skilled at business valuation, and maybe you are and maybe you aren't. But there's another element here, which is that maybe you could identify them just because you're lucky. Maybe, in the pick six lottery drawing this week, maybe 1, 2, 3, 4, 5, 6 will win. Maybe I just pick the lucky number and I win the lottery. I mean, you could put a lot of effort into trying to pick these, I call them super stocks. You might be able to identify one just by luck alone. And if it feels like skill to you, fine. I mean, pat yourself on the back. But I think it's important to recognize that the odds really are long. And, if we wanted to try to distinguish the people who can reliably do it, we would need vast amounts of data. I mean, by a lot of statistical tests, it takes decades to figure out whether a portfolio manager is skilled or lucky. And of course, the more volatile that managers' results are, and the more they differ from the results of the market as a whole, the longer the measurement period you would need to establish whether it's skill or luck. But I think this brings us to another point, which is in the book, I talk about 2 reasons to invest. And I call them investing as endeavor and investing as entertainment. And it's really, in some ways, just another way of distinguishing between defensive and enterprising investors. If investing is an endeavor for you, you're simply focused on the objective of earning the greatest possible return at the least possible risk over the longest possible time period. And in that case, again, you don't have to worry about best inventors' results. You just buy the whole market and hang on to it. And over very long periods, you should do well. But maybe investing is also entertainment. It is fun. Maybe you really enjoy studying annual reports and going into stores and company facilities and learning how companies operate and figuring out what is their competitive advantage. I remember many years ago having an appointment with a fund manager. This was when you and I were both working at Forbes, and I went to our pantry to meet him because the receptionist said that's where you went. And he was up on the counter looking at the back of the soda machine. And his butt was sticking out into the room, and his shoes were hanging off the edge of the counter. And I wasn't sure it was him because I'd never seen that view of him before. And eventually he got down off the counter, and I said, "What are you doing?" And he said, "This is a really good machine. I wanted to make sure I knew who made it." And, if you have that kind of mentality, then investing will be endlessly fascinating for you. And even if you don't outperform the market, you will get psychic satisfaction that could be very valuable to you. And it could have ancillary benefits in other aspects of your life. If you run your own business, you could learn a lot about how to run a business well by studying businesses that are run well for the purpose of investing in their stocks. And that could make you a better business person. And Graham wrote famously, I think it was in chapter 20, He said, investing is at its best when it is most businesslike. And of course, Warren Buffett has famously said that he's a better investor for being a businessman and a better businessman for being an investor. And so that's a long answer, but I think where I would come out is that even if the attempt to outperform the market fails by conventional measures, it may succeed in other dimensions, and it may well be worth your time. And it depends on your temperament, what kind of person you are.
I think, though, it's hugely important, as you've often done over the course of your career, to make clear just how difficult the game of long-term outperformance is. And it really brought it home to me when I was looking at chapter 9 of the book, which is titled Investing in Investment Funds. And Graham talked about how, I think back when he was revising the book, this around the end of 1970, he said there were 356 mutual funds with 50 billion in assets. And so he was talking about the challenge of picking the right funds when it's so bewildering because there are so many. And you pointed out in your note that I think there were now 6,973 mutual funds in the US with 18.8 trillion in assets.
Right. And not to mention the ETFs.
Right. And which is another $7 or $8 trillion. And not to mention all of the worldwide mutual funds, which you said have $63 trillion in assets. So the task of picking a good fund has become even more bewildering. And so then I was looking back at an article that you had written back when we were young journalists 26 years ago working together. And you'd written a really good and interesting story about long-leaf funds, which were managed by Southeastern Asset Management and co-managed by Mason Hawkins, who I've interviewed before for The Great Method of Investing, and by Staley Cates, who's really good. These are really good, really smart, really honorable people. And I was looking at their results the other day. This is for the Longleaf Partners Fund. This is as of August 31st, 2024. And basically since inception, 37 years ago for that fund, they've really added no value at all. I mean, and then more recently, it's even worse, right? The Longleaf Partners Fund has earned 4.03% annual return over 10 years versus 12.98% for the S&P 500. And I just wondered what that makes you think about, how it clarifies the difficulty of this game. Because they, in some ways, did everything right. They had the right mentality. They had the right framework. They say on their website, they give credit to Ben Graham for providing them with this framework. What's the moral here?
Well, so there's a couple of morals, I think. One is that active investing is expensive. And it's not just the explicit cost, like in a mutual fund's expense ratio, or in the old days, the commission you might pay. Or if you're buying individual stocks, obviously you have brokerage costs. It's not just the explicit costs, but it's the implicit costs. If you're a large investment firm like Southeastern Asset Management, you have to pay a lot to buy and sell a stock. It's expensive. And that can be a real drag on portfolio returns. But more importantly, I think, is that in the past 10 to 15 years, the historical value premium, the outperformance that cheap value stocks exhibited in the stock market has kind of faded, if not disappeared, and it may even have gone negative. The theories on that are very controversial, and everybody has what they say about opinions. Everybody has one. It's like a certain anatomical part, and everybody has an opinion on why value investing has underperformed. The explanation I kind of favor is that by mid-2000s, everybody had concluded that value investing was superior and would never underperform again, at which point it stopped outperforming. And I don't personally expect that situation to persist indefinitely. And there's some indication that it may have started to reverse already. But the power of indexing and also the kind of winner-take-all structure of today's technology industry may mean that value investing is no longer the sure thing that it once was. And if I could ask Ben Graham one question if he were around today, I know I would ask him, do you think value investing will again prevail? Because for quite a few years now, it has struggled.
It's such an interesting and challenging thing, right? Because he writes a lot about pendulum swings, and the pendulum swings are clearly eternal. And so there's this assumption, say, that, sooner or later, the pendulum will swing back to value investing. The pendulum will swing back to emerging markets and international stocks. But there's so much uncertainty. And I had an extraordinary conversation in England a couple of weeks ago. I was moderating a panel with Chris Begg, who I've interviewed on the podcast before, Frederick Blackford, who's a very smart venture capitalist, and James Anderson, who's this legendary, as he would put it, hyper-growth investor, who was previously at Bailey Gifford. And James Anderson had written an extraordinary piece back, I think in 2018, that I'm sure you've read before, where he was saying, look, this is a wonderful book, The Intelligent Investor, and Jason's done a brilliant job. It's fantastic, and he fathered all of these magnificent investors, but he posits the possibility that something profound may have changed. And what he was saying is that in recent decades, there are these companies that have, as he put it, have scaled superlinearly.
Yes.
And he said, is this a temporary change that is noise in the data or something more serious? And so one of the things that he was talking about was that, if you study Graham, you would assume there's this reversion to the mean, right? That all of these growth stocks end up kind of disappointing in the end. And I think this kind of appeals to people like you and me who are sort of contrarian. And there's something almost moralistic about it, that these idiots who bet that growth will go on forever will get their heads handed to them. And he says, actually, you look at all these companies like Alphabet and Netflix and Amazon since it went public in 1997, I guess it was, or Facebook since it went public in 2012. And he says, you have to wonder if something has actually changed. And that, when Graham was warning that you shouldn't participate in what he called glamorous and dangerous fields of anticipated growth, he's been proven wrong by this period. Can you unpack that a little for us? Because I think it's such a provocative and interesting argument.
Yeah, it is. And I know James quite well, and I have a lot of respect for him. He's a terrific portfolio manager and a very smart guy. And we've debated this, not in public, but over breakfast and lunch several times. Where I come out on this is maybe not a very satisfying place. I kind of think it's where Graham would come out. And where I come out on it is at several points in the book, Graham looks back at past data to draw inferences from the evidence of historical returns. And, he looks at 10-year, he looks at 25-year, but then he insists on extending it out to 50 years. And even then he sort of throws in the caveat that this might not be a long enough period to draw a sensible conclusion from. But what we do know is that there's an incredible amount of noise in financial markets. And James Anderson may well be right. He certainly has been right so far. That what he likes to call them West Coast companies. These companies that have this business model of the, dynamic, eccentric founder, the Elon Musk, the Jeff Bezos, the Mark Zuckerberg, the close coterie of original employees, maybe the dual class shares where outsiders don't get the same voting rights, and very long-term business plans where, Jeff Bezos famously didn't want to do anything that would pay off in less than 10 years. And this West Coast business model has worked really well for the obvious winners. But I mean, there's a couple things I'd point out. First of all, it's worked really badly for a lot of companies. You know, we tend to forget that the winners capture all our attention. And we forget entirely about the losers. And most of the losers in the technology industry had very similar business models to the winners. And a lot of what separates the winners from the losers is what a finance professor would probably call luck, and what the founders, or I would say maybe a fair objective observer, would call something unobservable. There's some magic, some je ne sais quoi to these companies that their competitors don't have. It's lightning in a bottle. And maybe you can recognize that. Maybe you see something that looks like it, but turns out not to be. But I think the question becomes, at what point do these companies grow so big, so fast, that they no longer can sustain that hyper growth that James Anderson is talking about? I mean, I would think if the company's growth just, is scaling at this incredibly rapid rate, and in fact, if it grows faster as it gets bigger, which is close to the case for a lot of the biggest technology companies, it's hard for me to imagine that that's indefinitely sustainable. You may remember, William, there was a point in the 1990s where Walmart was growing so fast. I think it might have been when it was just beginning its expansion into Mexico, but it was growing so fast that some analysts on Wall Street were projecting that it would become $1 trillion company in a few years. And of course, Walmart has grown really fast, but its growth rate has slowed down a lot as it's gotten bigger. Now, it's not a technology company in the same sense that, say, Alphabet is or Meta, but growth to some extent historically has sowed the seeds of its own destruction. These companies seem to be the exception to that pattern, and that's what James Anderson is emphasizing. He thinks it is an entirely new model of doing business. And it may be.
I think it's interesting that James and Bill Miller and Nick Sleep were all steeped in Santa Fe Institute kind of studies of network effects and the like. I think they did see something that the rest of us hadn't seen. I love this line from James Anderson's piece where he said, if you live in a technology and knowledge-driven universe of great complexity and initial path dependence, why wouldn't you expect the lucky emergent few to buck the notions of the fallibility of growth stocks? Mm-hmm. It may just be that something has shifted. I think this just gets us at the perennial difficulty of investing. It goes back to Munger saying, anyone who thinks this is easy is stupid.
Yeah, exactly. And, look, Munger got it right with Costco, and he got it right, at least for a good while, with BYD in China. But it's extraordinarily difficult. And, if it were easy, then you would see the founders of these companies, you would see their family offices that invest on their own personal behalf. You would see them earning the highest returns in the world because if Jeff Bezos, somebody's running his money and Jeff Bezos says, oh, that's the next Amazon, then you would expect he would know what he was talking about and they would buy it. And I don't believe the family offices of these company founders have done any better than anybody else, and they might not even have done as well. And I just think we can't emphasize enough how difficult it is to not just to identify a superior business model, but a sustainably unbreakable business model. Everyone in the professional money management business talks about moats all the time.
Yeah.
And there's a whole bunch of funds, actively managed funds, ETFs, that purport to identify companies with great moats. But, even Warren Buffett has made mistakes about moats. Not every company he bought that he thought had a great moat had a moat at all. And it's very tricky, very tricky.
The whole case of Geico is really interesting, right? Where Munger obviously has pointed out the irony, which Ben Graham admits to in the postscript of this book, that after spending a lifetime being so disciplined as a value investor, buying stuff cheap, that basically Graham ended up making much of his fortune off one high-quality company, Geico, that wasn't particularly cheap.
Yeah.
He made a very big bet. I think you point out that he put about a fifth of his portfolio in it, and then he rode it for something like 25 years. So in a way, Munger pointed out that there's this inherent contradiction that supports the idea that you don't just want to buy really cheap stuff that's undervalued, because Geico kind of violated all of Graham's own rules about concentration and valuation. And they're like, what do you think of the, like, what's your view on the whole kind of Geico controversy?
Well, so it's hard to disagree with the point Charlie Munger made. I mean, Graham himself, although he's a little coy about it, he does fess up. And, when you learn the details, it turns out that Jerry Newman, who was Graham's partner and name partner in the Graham Newman Fund, twisted his arm and said, "Ben, it's a good deal. Let's do it." And Graham didn't want to do it. And I believe that Graham wanted to pay, I think I remember this correctly, he wanted to pay $50,000 less for the block of stock. And I think it was the insider family, wouldn't budge on the price. And Newman said, "Come on, Ben, let's just do it." And they did. And so Graham, you can tell that he's wistful about this. He realizes that, the single most important decision he ever made wasn't in accord with his principles. And he probably wouldn't have made it at all if his partner hadn't talked him into it. But that points to another very important factor. And you don't need to look beyond Warren Buffett or Charlie Munger to recognize the importance of it, which is there's kind of a loose tightness or a tight looseness to a bunch of these ideas. Buffett has broken his own rules over and over and over again. And, he buys stocks in the public market when the market crashes, and then he buys companies in the private market when they're cheap. And when neither publicly traded stocks nor private companies are cheap, he does nothing and he just lets cash build. He doesn't feel he has to do something that squares with his principles if the opportunities aren't really attractive. And, here was Graham, who had all these policies and procedures and, in theory at least, ran everything through filters to determine that the valuation was attractive. And here he is, he's presented with a company that doesn't meet his standards. And in the end, he says, "Yeah, all right, let's do it." And it worked out great. And Graham himself says when he's describing it that, sometimes you can't tell luck from skill. And in effect, it doesn't really matter. If it works out well, more power to you, right? And this gets to part of the idea that investing should be fun and it should be engaging. And if you don't find it fun, you don't have to play that game. You can just be a defensive investor and not attempt to pick stocks, not attempt to pick funds. Just buy the whole market and, go to sleep for 30 years.
I think it also gets at one of the fundamental insights from Graham's writing, which is that the world is just a hugely uncertain place and everything is changing all of the time. And and we have no idea what's going to happen. And there's a lovely bit in one of the chapters where he focuses on 4 companies, right? Emerson Electric and Eltra and Emhart and Emery Air Freight. And you point out that only one of them still exists in that form.
Yeah.
And I was wondering what working on this old book teaches you just about the nature of change and impermanence and creative destruction in the world of capitalism.
It's kind of remarkable. Graham was writing in 1972, which was right after the disastrous collapse of Penn Central, which which then I believe was the largest railroad in the U.S. and was also the largest bankruptcy in American history up until that point, and was by far the biggest news event in financial markets in the early 70s. And of course, in 2003, when I edited the last edition of the book, railroads were moribund. Nobody cared about railroads. They seemed to be a dying technology. It's all about air freight and, maybe trucking. And of course, now railroads have done extraordinarily well. And Buffett has made a fortune on Burlington Northern. And you see that over and over and over again. And I believe that, Graham kept coming back over and over again to the same basic idea. You alluded to it earlier, William, that this too shall pass. But also, he talks about how the first shall be last and the last shall be first, which of course is from the Bible. And then he also quotes the Latin poet Horace in the epigraph of the book, saying something like, you will be safest in the middle way. And
in security analysis, he quotes as well, right? Where he says, many shall be restored that are now fallen, and many shall fall that are now in honor.
That's right. That's right. And so he's always conscious of the incredibly long time scale over which market cycles can play out. Of course, they can be very quick too, as we saw in 2020 and as we've seen since. But often they can take decades to manifest themselves and to reverse. And Graham gave a speech very late in his life. I think it was at his 80th birthday party. And he talked about how he preferred to view things his favorite philosopher, he said, was Spinoza. And he said, I prefer to view things through the lens that Spinoza provided, which is
eternity, right?
The perspective of eternity. And of course, Spinoza worked, do I remember this right? He worked as a lens grinder, right? And that was his day job. So he made microscopes and telescopes. And so Graham was, as somebody who was steeped in Greek and Latin philosophy and literature and who had traveled all over the world and spoke, at least a half dozen languages, he was always aware that, what's happening now is only happening now, and you can't count on it to continue. And, sooner or later, it's likely to reverse, but you can't predict when that'll be.
I think this gets at something so important and fundamental here, which is part of the greatness of the book, I think, is Buffett said, I think in the introduction or the preface, he talked about how Graham had an intellect whose breadth almost exceeded definition. And so because he was so steeped in literature, he had this kind of expansive sense of what can happen to mankind and how we go through these periods of disaster. And he had gone through terrible periods of disaster himself, right? We talked last time you were on the podcast about what he had lived through in terms of, wars and bankruptcies and Great Depressions and losing the family home and stuff. And I was very struck that at the start of The Intelligent Investor, he quotes this beautiful line from Virgil, where he says, through chances various, through all vicissitudes, we make our way. What does that make you think? Like the fact that he chose that line for the start of this book, and then in Security Analysis, the quote we mentioned from Horace, the Roman poet, about, many should be restored that are now fallen, etc.
Yeah. Well, first of all, he was kind enough to translate from the Latin, because late in Graham's life, he used to translate Homer into Latin and Virgil into Greek as a pastime. So we can be grateful that he actually translated those for us. But he did it because he wanted us to learn the lessons. I think it all boils down to something really basic and fundamental, William, which is intellectual humility. The markets are just full of people who have passionate conviction on the basis of fragmentary evidence, and sometimes they're just making it all up, or they think they know the answer when they don't know anything, or they know something that isn't true. And the message of the book is that the reason Graham emphasizes the margin of safety so much is because he wants you to look inside yourself and realize that I shouldn't just be calculating the margin of safety of this investment. I have to calculate the margin of safety of myself as an investor. Do I know what I think I know? How do I know what I think I know? What evidence is there that I might be wrong? And what has been the performance of the thousands, probably millions of people who've tried this thing that I've just discovered before? Why do I know something about this asset that most other investors haven't figured out? Why exactly would I be right when all of them are wrong? And by invoking classical literature and the ideas of regression to the mean and the futility of prediction and the difficulty of being right, and even the limitations of what human knowledge can do, Graham is trying to remind us, it's really important to sustain that sense of humility in yourself. And, you and I think, have talked about this before, although maybe not on the podcast. Many years ago, when I interviewed Buffett, I think for the first time, so 2003 or 4, I asked him, there's so many people out there who think you're a genius. But most finance professors think you're lucky. Well, how do you think about yourself? And his answer was really interesting. He basically said, I don't have any interest in thinking about that. Other than acknowledging that he was lucky to be born when and where he was so that he could make the most of the skills he had, to him, the question of his superiority was not interesting. And he spent no time on it. And it clearly wasn't an act. He was very matter of fact about it and very direct. Just like, I'm not interested in figuring out whether I'm smarter than everybody else. Doesn't matter.
One thing I thought was very interesting in Buffett's preface to The Intelligent Investor, where you reprinted, I think, an article that he'd written in 1976, right after Graham died. He talked about how more than any other man except my father, he influenced my life. And when he was trying to explain what made Graham great, not only as a thinker, but as a human, he said, in each relationship, just as with all his students, employees, and friends, there was an absolutely open-ended, no scores kept generosity of time, ideas, and spirit. And then he talked about how he embodied what Walter Whitman described as men who plant trees that other men will sit under. And he said Ben Graham was such a man. And I was wondering, when you think about lessons from Ben Graham's life, if there's anything that you've kind of internalized yourself that sort of changed the way you think about your own life or how you want to live your life.
The lesson I take away from Graham is one that's probably close to your heart, William, and very much in tune with your book. Graham wasn't very interested in making money for money's sake. Both Warren Buffett and Charlie Munger have told me that repeatedly, that Graham thought money was kind of boring. And, he was a wealthy man for his time when he died, but he could have made so much more money than he chose to. When he ran his mutual fund, it had a very low expense ratio. He paid himself a very decent salary, but when you calculated it as an annual expense, it was quite low. And he had no interest in marketing the fund or making it big. And the fund was quite small when he shut it down. And when he got out of the money management business, he just got out. He retired. He continued to teach. He taught into the 70s, but he put most of his portfolio into municipal bonds because he didn't feel like being bothered following the stock market every day. At the very end of his life, he got re-involved in what today we would probably call smart beta, factor investing with a stockbroker named James Ray. He felt he had identified value factors that would outperform statistically. Like if you bought hundreds of stocks that all had these same characteristics, you were likely to outperform. And the fund actually did not do very well, and that's a story for another day. But he was much more interested in spending his time with family and friends. And he was the founder of what later became known as the Buffett Group. Every year Graham would have a little reunion for a bunch of his friends at the Hotel Coronado in San Diego. And they would all go out and spend a couple days with Graham. Buffett went, Charlie Munger went, Rick Guerin went, all these leading investors. And they would debate things, and Graham would present mental puzzles that people would have to solve. And usually Buffett was the only one who could figure them out. Buffett and Munger often got them right, and nobody else ever could. And he enjoyed his life and didn't regard investing as a rat race. And it's very interesting the way he was able to turn his back on it after being one of the most successful people in the field ever. He just walked away.
He had extraordinary breadth, right? I mean, he had tremendous intellectual breadth.
Yeah. And, there he was in the south of France, translating an Uruguayan novel from Spanish to English and playing multilingual Scrabble with everyone at the table on his patio in southern France. So his wife was fluent in French. Some other visitor might know Italian or German, and each of them would play in his or her own native language, and Graham would still beat the French.
When I asked Charlie Munger about Ben Graham, he talked about that idea that I think is in the preface that Buffett refers to, where Graham had said something about how every day he tried to do something foolish, something creative, and something generous. And Charlie, of course, didn't pick up on the foolish bit. He picked up on the generous thing. And he said, that's a nice thought for an academic. And he said to me, he taught without pay for 30 years. And then he said, he helped a lot of people. It was a very worthwhile life. And I was thinking the same really could apply to Charlie, who died last November. And you spent a lot of time interviewing Charlie over the years, and you wrote a lovely reminiscence of him in the Wall Street Journal. And I was wondering if you had thoughts about important life lessons that you'd learned from Charlie as well, who, when you write in the book that Ben Graham was probably the wisest of investors, Charlie would be about the closest that you come in terms of wisdom.
Probably. Yeah, I think from both him and from Warren Buffett, I think I've learned a lot about the importance of teaching. Late in Munger's life, he spent enormous amounts of time meeting with people over lunch, over dinner, sometimes traveling to them. More often they traveled to him. Politicians, academics, entrepreneurs, venture capitalists, fund managers, just business people, even students. And he would just talk and share what he'd learned in this unbelievably long life. He died a few weeks short of his 100th birthday, and he was still going. I mean, I interviewed him I think it was the end of October or the beginning of November, and he died, I think, at the end of November of last year. And he hadn't lost a step. And, Buffett does the same thing. He still meets with groups of students. And in the old days, he used to travel a lot, and he would go to MBA classes, he would go to undergraduate classes, and just talk about life. And these guys are very, very wise. And it's kind of interesting. I think in Western culture, we've lost a lot of the reverence that's so common in other cultures around the world for our elders. A lot of Americans, certainly, and I think some Western Europeans, kind of regard their elders as a burden. And, in places like Africa and Asia and Latin America, elders are revered. And we've kind of lost that. And I know in Renaissance Venice, if I remember the way I've read about this, I think you couldn't become the Doge, the Duke of the city, until you were at least 85 years old, on the theory that you wouldn't be wise enough to govern well. It might also have been because you wouldn't be around for too long. But we see the same thing with the papacy, for example. I mean, popes tend to be kind of old. And Americans kind of like to mock that sort of thing. But maybe we should learn to be more reverent of the wisdom of older people. And certainly, when Graham held these groups in San Diego, these investors would come from everywhere to spend time with him and learn from him. And Buffett has continued that tradition with what he calls the Buffett Group.
I wanted to ask you one final thing before I finally let you go, Jason.
Mm-hmm.
In the acknowledgments, you end the book by saying, above all, I thank my wife. She did everything but this, so I could do nothing but this. And you also once wrote to me, without our wives, we're nothing, which is pretty true, I think, because certainly my wife, Lauren, keeps me on track to an extraordinary degree. I would kind of disintegrate otherwise. I wonder if I could just ask you to say something about your wife and how she's made your career possible. And there's something kind of funny about the fact that you've written hundreds and hundreds of columns filled with investing advice. And I sort of figured I should actually hit you up for some relationship advice that you can share with us, since you've been married to a remarkable woman, Liz, for decades, and she's put up with you to an astonishing degree. So what's worked and what marital advice can you dispense to us?
Well, first of all, William, thank you for getting me in incredibly hot water, because my wife is an intensely private person. She's going to kill me when she finds that I answered this question.
She'll never make it to the end of the podcast, yes.
Well, that could be, but she might hear about it from somebody, and that might be worse. So when I was working on the book, and I alluded to this before, but because she's so private, I left her out of the answer. You asked me what sort of rituals or routines did I have. So when I was working on the book, she was on sabbatical by coincidence. She was on sabbatical while I was working on the book. So when I took that morning walk, she went with me. So we walked 2 or 3 miles every day before breakfast, and it just got my workday off to an incredible start. And she's amazingly supportive and patient, and puts up with all kinds of nonsense. And it was quite literally true that for 7 months, I didn't have to do any of the normal thing. I usually contribute a little bit around the house. I do some of the cooking. I do some of the cleaning. And I run quite a few of the errands. And she just took all that off me and just did it all. And if she hadn't done that, I don't think I could possibly have finished. And relationship advice, I don't know what else to say except take it one day at a time, which I think is the best advice anybody can give you. Can give one. I don't mean to imply I'm giving you advice.
Why is that such important advice?
Because I think people have a tendency to live either in the past or in the future. And when things are going poorly, they will compare to some period in the past when things were better and say, oh, if only we still had that spark. Or when things are going well, they worry that down the road, oh, we're not going to have that spark. And instead, just, live for today and enjoy the moment and be grateful you have somebody who's good with you and good for you. So, and just by the way, Ben Graham, you wouldn't want to ask him that advice.
I mean, it's interesting, right? A lot of the great investors that we write about have had these lousy personal lives where they don't talk to them, or their wives hate them, or their ex-wives hate them. And I don't know. It's one of the quandaries, I think. How do you become a super high performer at what you do without wrecking the lives of the people around you?
Yeah, I mean, I think it's just you have to find ways to keep your workaholism and obsession in check. And I think Warren Buffett would tell you that when he was young, he neglected his kids to an extent that, he probably regrets today. Although obviously it was a big part of his financial success. But I think he probably wishes he could have a do-over. Because when you're that driven, you kind of put everything else aside. And look, my kids are out of school, they're older. And if I had tried to do this when my kids were young, I don't want to predict how it would have worked out.
I was almost going to ask you this at the start of the conversation, because it's something I've been wrestling with a lot myself, where I had written to you back when we were first discussing you doing the book, and I'd said I'm trying to practice letting go more in my life, not trying to control things quite so tightly. I feel like I've always been battling everything with gritted teeth, and it's too difficult and draining. I want to try to do the same things, but with more ease and lightness of spirit, less of a sense that it's all a gladiatorial battle to the death, which is still something I battle with constantly. And you sent me this lovely quote from Philip Roth, the great novelist who both of us love, who said, "Sheer playfulness and deadly seriousness are my closest friends. That's the formula to describe the concoction that energizes virtually any writer worth his or her salt." And I thought that was just so interesting, that it's like you somehow want to go about these pursuits, whether it's writing or investing, with deadly seriousness and at the same time sheer playfulness.
Yeah. I guess one way I have described this, now that you mention it, is that I take my work incredibly seriously, but I don't take myself seriously at all. And another way to put that is I have ego in my work, and I have no ego for my work. So I throw everything I've got into it. I leave nothing on the field. But when I'm done, if you ask me, it's great, right? I'll say, probably not. It's probably somewhere between terrible and okay. And I'm not really faking it either. I mean this.
I think I'll leave you on this note, but I think the stars kind of aligned on this project, and it played to your strengths in a beautiful way. And you kind of took this, timeless but slightly worn book and breathed new life into it in a beautiful way. And you made the lessons very timely, and the principles are very robust. You did a lovely job. So you may not give credit to yourself, but I'll give you credit.
Well, that's very nice, William. I hope you're right.
I'm always right, Jason.
Yeah, see that?
No, there are many things that I'm wrong about, but I think I'm right about this one because I have judgment about your work, and I've seen your work for many years, and you nailed this one. It's a beautiful
thing. Thank you.
But congratulations.
Thank you. Well, as the marketplace will decide, so.
Yeah. All right. Well, thank you so much. It's been a treat as ever talking to you.
Yeah. Well, thanks, Williams. Great. Absolutely.
All right. Take care.
Hi, folks. This is William Green, host of the Richer, Wiser, Happier podcast. Before you go, I wanted to share some news that I'm really excited about. Later this year, I'm going to launch a Richer, Wiser, Happier masterclass,
for a very small, intimate group of people who'd like to study with me over Zoom and also interact with me in person over the course of a year. This is going to be a totally unique experience because it's a tiny group of 10 to 20 people. We're going to meet once a month over Zoom to discuss the most important themes in my book, and I'll also talk about how my thinking on these subjects continues to evolve. Members of the masterclass group will also be invited to join me at a couple of very special events. One is a day in New York, which includes a private lunch and then a book launch party for the paperback edition of my book, which is due out in January. Then, during the weekend of Berkshire Hathaway's annual meeting, you'll join me at a private dinner in Omaha, where we'll discuss what we've learned from listening to Warren Buffett speak earlier that day. My goal in forming this masterclass group is to create a year-long journey of exploration for people who are deeply interested in building lives that are truly richer, wiser, and happier. If this appeals to you, please email Kyle Grieve, who's in charge of the waitlist. His email address is Kyle, that's Kyle, at theinvestorspodcast.com. And if the stars align, I'd really love to see you later this year when the masterclass begins. Thanks so much.
Warren and Charlie and many of the people you mentioned have done well as they've structured their lives so whatever their weaknesses are, it hasn't taken them down. And so you mentioned Charlie's bluntness. I don't think that would have served Charlie as the CEO of a Fortune 500 company. So Charlie structured his life in a way where those personality traits of his didn't set him back. Warren is an incredible communicator and exudes this sort of warmth and people can feel, but he has a very hard time making those really hard decisions to fire somebody or to replace them. So he's structured his life to minimize those. A very powerful lesson for people to carry out is not to necessarily obsess on your weaknesses, but to do your best to structure your life so that you can avoid a lot of them.